St. Louis Fed President Jim Bullard says recession fears are overblown and the Fed should continue raising interest rates to counter inflation. Bullard making those comments in an interview with Reuters yesterday. Joining us now, Peter Boockvar, CIO at Bleakley Financial Group and a CNBC contributor. So on the Fed, we now know for a fact that there is quite a bit of division on what some of the different players are thinking at this point. We had Austin Goolsbee on last week, who was intimating that he would pause right now. He wanted to wait to see more data, but I mean, his body language was that he thought maybe the last one might not have been the right move, and another one you need to think long and hard about. Now you see Bullard and others, Mester. So what is that normal, Peter? Do you normally see that on the Fed?
Well, this is actually the first time where there's some vocal dissension. I happen to believe and agree with Austin that there's nothing wrong with pausing. Just because you pause doesn't mean your inflation fight is over. There's a meeting just 6 weeks later after the May meeting. I mean, we had a big event on March 9th. I look at the economy this year as sort of two parts, pre-March 9th and what we're going to see post-March 9th. And it's going to take more time to see how this plays out. So the Fed is really sort of hiking based on pre-March 9th data. And I think it's just more prudent to wait to see what comes in over the next month or two.
So you're talking about the regional banks and the problems there.
Yes. I mean, if you're a loan officer at a bank right now, you're not really aggressively looking to expand your loan book. You're looking to reduce it. You're looking to actually contain risks. So that in itself slows things down, and it's the small, medium-sized business that is going to be most impacted. But it's not just those businesses. We've seen sort of a dry up in all different parts of the capital markets, whether it's VCs, whether it's IPOs. But this is not an event. This is a process that takes time and slows things down. It results in slower activity, slower cash flows, which then leads to potentially slower hiring and less capital spending. And it takes time to play out. And I think that the Fed and Bullard and others are making decisions right now on very much rearview mirror data.
So, Peter, your hesitance in raising rates doesn't necessarily have to do with thinking something else could be broken with another 25 or 50 basis points. You don't think that the tide goes down a little bit more and that you find someone else without a swimsuit? You're saying that what's already happened is good for a half a point or 3 or 75 basis points of credit contraction based on what's already happened. Do you think if they continue to go up, they're risking breaking something else or not?
I think they very much are. I mean, if they should be in the risk management business. And when you think about what's the reward of hiking another 25 relative to the risks, and to your point, which Austin estimated that the credit slowdown could be the equivalent of 25 to up to 75 basis points of rate hikes. I think it's better to just see how this plays out, like I said. And just keeping rates at current levels for a longer period of time in itself is a constant form of tightening, because the problem the economy has right now is everyone's loan who's coming due this year is going to get repriced at a much higher interest rate than the loan that is maturing. And that borrower either is going to have to work out a deal with their banks, is going to have to come up with more equity, and whether you're in commercial real estate and whether you're in any other business that has debt coming due this year, it is going to be a big problem, because that's what happens when you have 15 years of basically zero rates and you have this vertical interest rate shock to the upside. There is a constant sort of bleed each month, again, for those that have debt coming due or those that have floating rate that are constantly resetting.
And Peter, you saw that yesterday with Brookfield walking away, I think, from another 12 buildings, commercial real estate in Washington, D.C., after walking away from a couple of big buildings in Los Angeles a month or a month and a half ago. I mean, those are, if it gets to the point where all of those real estate companies are willing to say, we're just going to walk away from this and leave this for the banks, I think that's the question of what the next leg down is. What do the banks do with that? You got to reprice it and reprice it down sharply. The banks don't want an office building that's 60% occupied. They don't want it.
they're going to have to work out a deal of some sort. And it's more than just office. Office is obviously challenged. But you look at multifamily, where you can have a 97% occupancy rate, but if you have a poor capital structure, you may be handing back the keys too. Now, that's something the bank will want back because of that high tenant occupancy. But we saw that just a week ago where an owner of Houston apartment buildings that bought it in 2021, that took on too much debt, didn't term out their debt, had floating rate, and just a year and a half later, they're selling it to some distressed buyer. So it gets back to, again, the balance sheet and those that didn't term out the debt assume that rates would stay low forever. And that's what happens when you get such like I said, a sharp rise in interest rates in just 1 year after basically a flat line for 15 years.
Give me a 10-second answer. Bullard says, not even sure there's going to be a recession. There will be a recession. It will be a mild recession, a deep recession. In what year? Fast.
It's going to be a recession. I think if it's mild, it could be drawn out. If it's sharp, maybe it'll be quick. So a mild recession is not necessarily a good thing if it lasts a bunch of years.
Okay. And it comes this year or next?
I think it's probably started in Q2 post-SVB.
Okay. All right, Peter Boockvar.
If it already started, it's already built into the market. That means that 12 months from now,
it'll be 19% higher on the S&P. Possible it's already.
We hope.